Hello investors, welcome to Simpli Stocks. Although almost all green energy stocks have witnessed a correction, Websol Energy has fallen quite significantly in the last 1 month and it is down 50% from its all-time high. However, Websol is a much better business than other solar manufacturers. That is why today we will talk about Websol Energy and we will try to understand what approach investors should have regarding it now. Is there any opportunity here for new investors? And should investors who are currently invested in Websol view this correction as an averaging opportunity or not? With that, let's begin. So everyone knows that green energy is the future and this sector is also growing rapidly. So we won't spend our time on that. We will go straight to solar manufacturing. Websol is a solar manufacturer, meaning they are in the business of making solar cells and solar panels, which are also called solar modules. A module is built in 5 steps. From polysilicon, ingots are made, then wafers, and further solar cells and modules come. Many solar cells are put together to form a panel. Now, the fact is that most companies in India simply import cells from China, assemble them here, and sell them as solar panels. There are very few companies that manufacture solar cells, and Websol is one of them. Furthermore, in the entire process of manufacturing solar panels, China has a sort of global monopoly. But China is an enemy country for us, and in the future, everything will run on solar and wind power. So it is very important from the point of view of energy security that India becomes self-reliant in solar manufacturing. If this is not done, there is a very good chance that China can use power as a weapon in the future. You see what is happening with rare earth metals right now, right? So that is why the government is providing a lot of support to solar companies, because without this support, Indian solar companies will not be able to compete with Chinese players. Their products are very cheap. And as part of this support, the government has ensured that only those solar panels are procured in government tenders that are made from cells manufactured in India. The government has released ALMM 1 and 2 or approved list of models and manufacturers, which covers Indian module and cell manufacturers. Other similar steps have also been taken. Import duty of up to 30% has been imposed on Chinese solar cells and modules, and GST on cells, modules, and inverters has been reduced to 5%. So if you want to sell your panels under any government solar scheme, such as rooftop solar scheme or PM Kusum scheme for solar irrigation pumps, you can only supply them if those panels are made from Indian solar cells. Due to this, a very large demand-supply gap has emerged in the market. The demand for Indian cells is very high, but there are not many companies manufacturing solar cells. And because of this, Indian solar cells are selling at a very high price, and this demand-supply gap will continue until next year. The cell capacity in India is around 18.5 gigawatt, but the annual demand is projected to be 40 gigawatt. Companies that have their own solar cell capacity are currently earning very high profits. This means that a good solar business is one that has solar capacity right now. Websol currently has 1200 megawatt of cell manufacturing capacity. Tata Power, Adani Enterprises, Waaree Energies, and Premier Energies also have operational capacity. You will find many small cap names like Solex, Alpex, etc., which although claim to be solar manufacturers, but right now they don't have operational solar cell capacity. Everyone is lagging behind right now. Most small cap manufacturers or Vikram Solar even, the cell plants of all these companies will become operational next year or the year after that. Now a humble request, if you are liking this video so far, do give me a thumbs up. Also, you can subscribe to our channel Simpli Stocks, where we bring multiple such videos every week. Honestly, your likes and subscribes are our only motivation so that we keep bringing such high quality research to you for free. So do like this video and yes, also subscribe to our channel. Now let us return back to our discussion. So the biggest difference you need to understand right now is that a solar cell is a different product from a solar module. And I will say it again, a good solar company is one that currently has its own cell capacity. It is not about cell capacity will come next year or the year after that. Does it have solar cell capacity right now or not? Because companies in India are expanding very fast. And now there are no high profit margins left in modules because so many new players have entered. Module prices have been falling constantly, and as more capacity comes online, prices and margins here will fall further. This sector is becoming commoditized. Commoditized meaning that all companies have the same technology and all players are making similar product. It is not like Waaree's solar panel is very different from Premier's solar panel. And now one negative thing and actually more serious thing that has happened is that prices in cells have slowly started to fall as well. I recently learned through my private circle that new contracts being formed for cells or being signed for cells are happening at lower margins. Because of this, the market's perspective on solar manufacturers is changing. Margins are still very high. For example, if Websol was previously or is right now at 30% net profit margin, it might now come down to say 25%. 25% is not a bad margin, but market looks for consistency because here there will be a risk that in the year after next, Websol's margins might fall further from 25 to 20%. Therefore, companies that currently have their own cell capacity are minting massive profits in the short to medium term. Only those players will do well who rapidly move backward into the manufacturing chain. Say they were making modules, now they are making cells, and next year or year after that, they start making ingots and wafers too. Margins are starting to normalize in cells. Now your ingots and wafers will become high margin products. In such a scenario, many players who do not have their own cell capacity are not going to make money for their shareholders. They will cause losses for their investors. Here, only integrated players who already have their cell capacity will have a chance. And Websol is exactly such an ideal player for us. You will see in this screenshot that until last year, they had 600 megawatt of solar cell and 550 megawatt of module capacity. They have added another 600 megawatt of cell capacity this year. The total cell manufacturing capacity has increased to 1200 megawatt. They have also announced their expansion plans. By 2027, they will be taking this 1200 megawatt cell capacity to 3200 megawatt, and by 2028 to 5200 megawatt. And their target is to make module manufacturing capacity from 550 megawatt to 4550 megawatt. Their management has done very good planning to keep module capacity low because you see many players have already entered the module segment and competition is increasing. So it is better to focus on cells, ingots and wafers more now. And for ingot and wafer manufacturing in the future, they have signed an MOU with Linton Crystal Technologies of the USA. Under this, both companies will be working on technology to manufacture ingots and wafers in India. So looking at all this, we can say that even though there is an opportunity in Websol, there is also a very big risk of margin loss, which many new investors must pay close attention to. The risk of margin loss is that, say, if sales growth comes in at 60%, but since net profit margin has fallen from 30% to 25%, then your profit growth might only remain at 40%. You will not immediately see this margin compression happening from Q3 results. It might take some time, but yes, you will have to listen to the Q3 con calls of these two cell manufacturers, Waaree and Premier, to know what is happening with cell prices. Waaree and Premier's con calls are important because Websol doesn't conduct con calls. Waaree and Premier are two most ideal players with operational cell capacity. Although one good thing that has happened in Websol is that they have released such a detailed investor presentation for the first time after Q2 results, where the company has disclosed everything. Websol's investor communication has been a bit weak so far, I will say. This company does not conduct con calls, etc. They only did press releases. But for the first time, they have released such a detailed investor presentation in which they have disclosed all their future plans. In this, they have also talked about their clients. For example, they supply their cells to these companies and solar modules to Exide, Oswal Pumps, Panasonic, Mahindra, etc. Now see, I told you that they had one unit of 600 megawatt cell capacity and a new line of 600 megawatt has recently become operational. The old cell plant has been operating at 90% capacity utilization, And in Q2 or in the months of July to September, production fell slightly because the new plant of 600 megawatt that they installed had to be integrated. But now their unit 1 has again reached 95% capacity utilization. And here is another very good thing that we are seeing. The capacity utilization of unit 2, which recently came online, has also increased to 51%. This is quite good that Websol has increased the capacity utilization of its new plant so quickly. Here they have also talked about their module business. You will see their module manufacturing was always low because they did not have enough cell capacity. But now with their own cell capacity coming online, the capacity utilization in their module segment has also increased. Now listen to me very carefully here, because this will help you a lot with Websol's valuation, which we will do in some time. So in Q1, at 90% capacity utilization in unit 1, their sales were approximately 200 to 220 CR. In the months of October and November, unit 1 again reached maximum 95% capacity utilization approx, and unit 2 had 51% capacity utilization. So according to me, the company will easily achieve sales of at least 300 CR in Q3. And this is very conservative estimate we are taking. We are not considering the sales that will come from module production and increased production in December. Now we will use these estimates for our valuation. You see, I was talking about sales of 200 to 20 CR, and you will see the same in their results. Their sales were 219 CR to be precise in Q1, and they fell to 168 CR in Q2. Here you will see that margins that I was telling you about, how high the margins of cell manufacturers are right now. The company's EBITDA margin has been above 40-45% for a long time, and net profit margin has been around 30%. That is why I am saying to you again and again, you should look at only those solar manufacturers who currently have their own cell capacity, because even though margins in cells will fall in the future, for now their profit margins are very good and they are minting a lot of money which they can invest in future growth. And when a stock with such high growth, high profit margin corrects, it creates a very good opportunity due to the low valuation. Just 1 or 2 quarters of good results have potential to push the Scripps price up. To explain this, I have created this table for Websol's valuation. And yes, as a standard disclaimer, this is not at all a buy or sell recommendation on Websol's stock in any way. I am not giving you any price prediction or price target here. Anyway, so let us continue. Websol has corrected so much and it is currently trading at a PE ratio of approximately 20. Combining Q1 and Q2, the company has achieved sales of around 400 CR. And I explained to you, right, that sales of around 300 CR can easily come in Q3. And if we take a slightly higher estimate of 350 CR sales in Q4, then company's sales for entire financial year FY26 can be around 1000 CR. And if we consider 45% EBITDA margin and 30% net profit margin on this, Websol will be making a profit of approximately 300 CR for this whole year. Similarly, if we calculate the numbers for the next year, for example, in Q1, the company achieved sales of around 200 CR on 600 megawatt of cell capacity. Now another 600 megawatt of cell capacity has arrived. In this scenario, the company's quarterly sales can be around 400 CR next year. So 400 into 4, Websol sales in FY27 can be around 1600 CR. But from FY27, there will obviously be a very big risk of margin correction. So in my understanding, the net profit margin can fall to 25% or even 20%, who knows. And net profit can remain at 400 CR at 25% margin assumption. Right now, you will see Websol's PE ratio is 20. And if we calculate the forward PE based on estimated profit for this year, it comes out to 13. And based on the profit for next year, Websol's forward PE for FY27 comes out to just 10. So you see, the stock has fallen so much that it has become a high value stock due to the growth and margins. But at the same time, the entire market's perception of it has changed. This is a very big risk in itself. Because of this, even if Websol shows a lot of top line growth, that growth will not translate to bottom line because of margin compression. And its re-rating might not happen from here. The stock will continue to trade around P of say 15-20. And although we saw that current demand supply gap in Indian cells will continue in the future as well, but yes, margins will slowly come down for sure. Module capacity is certainly coming in at a lot of speed, at a lot of pace in India, and module prices are falling. But cell manufacturers will have 6 to 9 months to earn high margins. After that, even cell prices will start falling. So Websol is a good business that you can study yourself once. Due to correction, its valuation has become quite attractive. But along with that, the risk of margin compression will remain there. For new investors, the opportunity is not that good in such a risky environment, but those who are already invested here can have some hope if margins do not fall too quickly in cells in future. Now, if you found this video helpful, please like it, and yes, also subscribe to our channel. If you support us by liking and subscribing to our channel, we will be able to bring more such videos for you in the future. So I'll see you in the next video. Happy investing.